Hello, everyone, and welcome to our Q2 2024 web capsule. I'm here with Joseph-Antoine Migdalani, our financial planner, and myself, Kareem Zakir, your portfolio manager. We're going to break this capsule down into two segments. The first one being a little brief discussion on the capital gains tax inclusion that was imposed as of June 25th, 2024 by the federal government. And then we'll talk about the markets, the situation we're in right now, which is quite positive. But we have to also reflect on 25 years of economic and financial history that we'll touch on a little bit, because it could determine where we're headed going into the future. So on that note, let's begin with the capital gains inclusion rate information.
Perfect, Kareem. Okay, so let's discuss now about the capital gain new tax rule inclusion. So before we start, what's a capital gain? Very simple. Capital gain is when you buy an investment and you resell the same investment at a higher price that you purchased the investment initially. So I did a small case here where someone is buying, for example, a second property or a rental property at a price of $500,000 and is reselling the property at a price of $1 million. So in this case, there will be a capital gain of $500,000. Before the new rule, the capital gain was taxable at 50%. Now things are a little bit different. You will have the first portion of $250,000 that will be taxable at 50%, but the second portion of $250,000 will be taxable, 66.67% will be included in your taxable income. So this being said, if we add these two together, $290,000 for this transaction will be added to your taxable income compared to before June 25th. The added amount would have been $250,000. So for the same situation with the new rule, $40,000 more will be added to your taxable income. Which is going to bring me to my second point, the type of revenues inside of a portfolio. You usually have three types of revenues. So you will have interest, dividends, and capital gain. So let's take this example for someone that is in the higher tax bracket. The interests are taxable at 53.3%. Dividends are taxable at 40%. And before the new rule, capital gains were taxable at 26.7%. So it was a no-brainer before. Capital gains were the best choice of revenues because they were the less taxable. But with the new rule, now 35.5% becomes taxable. Third topic here is the holding companies and the trust. So the new rule is applying directly on the first dollar of capital gain that is generated. So that makes a huge difference, Kareem. That makes a huge difference. For the capital gain exemption for the operating company before the new budget and the new rule, it was $1 million that was exempted as a capital gain when you're selling an operating company. Now the new amount is $1,250,000 that is possible to be exempt from a capital gain selling of a business.
Thank you very much, Joseph. It's very pertinent, could be very important to a lot of people. It's important to say that if you encounter this situation, you're fortunate enough to make a very large capital gain, and you don't want to be hit with high income taxes, give us a call, because we have certain tax shelters that are made available to our clients, such as flow-through shares. It's something I have to explain in more detail. I can't do it on the web capsule. You could run it by your accountant, your tax specialist, and see if it maybe is to your advantage.
Let's jump now into the second topic. Kareem, you've been in the industry for many years now, a portfolio manager for many years as well. I want to ask you the question, what did the market teach you during the last 25 years?
Let's begin with what's going on now. So the markets are doing very well, and main participants in this market that's pulling the market up since actually January 1st, 2023 are the Magnificent Seven companies, the technology sector. And it's all because of artificial intelligence. It is going to be fundamental. Let's look back at time first, okay? Let's zoom back and get it and see what happened over the last 25 years, okay? So we've been through a lot, okay? Especially me being in this industry, I've been through a lot, and more than 25 years, by the way, but let's just go back 25 years. So we've been through the technology bubble back in 1999. Had you invested in the NASDAQ, which is comprised of technology stocks, at the peak of the bubble in 1999, and the bubble, of course, we all know it burst in 2000, it would have taken you 14 years to recuperate your money. Now, if you were smart enough to invest a year prior to the peak of that bubble, it would have taken you 11 years to recuperate your money. So we must remember that these scenarios can unfold.
Right.
In addition to the bubble, I mean, we've had over the last 25 years wars. We've had terrorism. We've had our housing crisis in the United States, a financial crisis around the world, and more recently, we all remember the pandemic. And so we have to also look at the fact that cycles do repeat themselves to a certain degree. They're not identical, but they do rhyme. And eventually, in the next 5, maybe 7 years, something's going to happen. It's expected. And the only way to mitigate one's portfolio is to be properly diversified, which means that you need to buy uncorrelated assets within the portfolio. It's our responsibility to manage the risk within a portfolio. And often I get asked, well, why isn't this stock going up? And why is that thing not doing, anything? The simple reason is you don't want everything to be correlated. What's going up today may not go up tomorrow, and what's not gone up today is probably going to go up tomorrow. So you want to have an uncorrelated portfolio. You want to be diversified, because diversification is like an insurance policy. It protects you from situations like 1999. By studying economic and financial history, you'll have a better grasp as to what can happen. And it will happen. It's just a matter of time.
Right.
Right now, we're enjoying a nice rally. I'm expecting it to continue into the end of the year. It will not be a straight line. Expect volatility. But the reason there's a rally is because, like I said earlier, artificial intelligence is going to change the world. It's beginning to change the world. Just like the electric light bulb changed the world. Just like the automobile changed the world. Just like the internet changed the world. Look what we're doing right now, Joseph. We're communicating through the internet, something we could not do 25 years ago. So the world is going to change, and we've got to change with it. We've got to be invested in the right sectors in order to profit from it. But at the same time, we must always be vigilant that things can happen. It could turn on a dime. So I'm still very hopeful. It's also good news that the Bank of Canada lowered its interest rate by a quarter point last June. It looks like there's going to be another couple of drops between now and the end of the year with their interest rates. That's going to be positive for financial assets. The central bank in the United States, or I should say the Federal Reserve in the United States, is also looking to lower rates. So expect a couple of drops between now and the end of the year. Again, positive for the markets. Throw in the fact that there are people sitting with at least $6 trillion in cash on the sidelines. This is eventually going to make its way into the market, because this is the least liked bull market I've ever seen, or one of the least liked bull markets I've seen. Many are not participating. That's not the case for our clients, because our portfolios are doing well along with the markets. But there are many people sitting on the sidelines waiting for Armageddon and things to collapse. And it never really goes that bad, okay? When markets go well, people think it's going to continue to go well. And when markets go badly, like in 2020 during the pandemic, people have this belief that it's just going to keep going bad forever. It's not the case. Markets work in cycles. On that note, I want to say thank you for listening to us. Enjoy your summer. We'll be back in October, just before the US election. So that's going to be interesting to see what transpires with that. See you soon. Bye.